The next fund on our radar this morning is the Nedgroup Investments Global Property Fund, and I'm joined by none other than Rob Promisel, who is dialing in all the way from New York. Rob, thanks for joining us.
Thanks for having me. It's nice to speak with you again. I'm pleased to discuss with you performance for global REITs and the fund for the December quarter of 2025. It was a good quarter as we see it on an absolute basis, slightly positive, and more strongly positive on an excess return basis, over 100 basis points of relative performance. And over time, we have sought to match or beat the benchmark, and we're pleased to talk about what really the drivers were for that in the recent quarter. If we were to go to the next slide and look at the key drivers of performance in the quarter, on the left side, you'll see performance attribution by property sector. And again, this is a diversified property fund across multiple property sectors. And on the right side, you'll see attribution by regional market. And so it's diversified geographically as well. In the most recent quarter, the fund's strong overweight exposure to self-storage was a key contributor to relative performance, really driven by performance for self-storage stocks in the UK, Europe, and Australia, as well as the underweight in self-storage in the US. That next up was retail, which is the largest exposure in the fund, not a significant overweight because it's a large exposure in the benchmark. And then healthcare, which is the largest sector overweight in the fund, had strong performance from a couple of key holdings that focus on seniors housing. At the bottom end, industrial had a strong performance, and the fund is underweight industrial due to limited pricing power. If we look at things on a regional basis, the exposure to the US is the largest contributor to relative performance. It represents a little over 60% of the overall weight of the portfolio, a very diversified universe of stocks listed in the US. Australia, New Zealand, really Australia, the exposures there were contributors. There were self-storage company, National Storage, as well as retail and diversified companies there. And then Japan shows up as having a good quarter. We'll talk about that in a little while. If we were to flip to the next slide and look at the sector positioning, it's as I said, on the right side, you'll see the overweights or underweights by sector. And on the left side, you'll see what the actual aggregate exposures were. So retail is the largest exposure, but healthcare is the largest overweight. And then you can see the underweight in industrial. And it's underweight really because while we're really quite constructive on industrial fundamentals over time, we just don't believe that the pricing is reflective of the challenges the landlords face right now with regards to supply and uncertain demand trends. If we were to flip ahead and just look at a slide that says portfolio reflects economy relevant real estate. This is really thematically where the core of the portfolio is constructed around. It represents just about 2/3 of the overall portfolio. Going from left to right, you'll see retail represents nearly 20% of the portfolio. That includes a combination of necessity retail, grocery anchored retail, primarily in the US with strip shopping centers, as well as regional malls that have grocery anchors in Europe, the UK, and Australia. And increasingly, we're having a discretionary component to the retail due to the strength of the consumer. Healthcare is really seniors housing is the key driver within the healthcare exposure. That's driven by the aging population. Self-storage, we find value in self-storage, particularly in the UK and in Europe, and now in Australia, where one of the holdings is subject to a bid. Residential, we find that there is a demand for housing that is not being met via construction. And so rental housing is, we think, an essential part of anyone's portfolio. And then data centers and towers, we're going to hear more and more about the digitization and AI of the economy going forward. We have exposure to two companies that are the largest owners and operators, really developers of data centers in the world, Equinix and Digital Realty. So in aggregate, these five sectors represent about 2/3 of the portfolio's overall exposure.
Thanks, Rob. I love how you dove straight into it there. And I was going to ask you a bunch of formalities, but you kick-started. Time is a precious resource, so thank you for going through those first handful of slides. Last time we spoke, you were in the throes of a July heat wave, and I believe you have a foot of snow there currently. So looking at your chart on real estate development being uneconomic, I guess you could say that the heat is back, and the property sector there is feeling the heat of the tariffs by the look of things. And am I correct in saying that it becomes more costly now to develop new properties as opposed to accumulate old ones? Is that what this is essentially trying to say?
Yeah, so remember, we're investing in the owners and operators of real estate. They own standing assets. At the margin, they are also developers. They're also investors, so they could acquire assets or they could develop assets. But the majority of their cash flows are generated by collecting rent on existing properties. And I say that because it's important to remember that point of view. Right now, we are seeing steady and growing demand in general for most property types and most markets. Not everyone is always rowing in the same direction, but we are constructive and optimistic about trends in demand. There is uncertainty, certainly, but we think that the direction is for stability and strengthening. So that's important. And then it's also, we're at a point right now where supply is becoming more benign, meaning there is far less new construction going on than there used to be. And that's because, as this slide shows, the replacement costs have increased tremendously. Yes, tariffs have been an important part of the increase in materials costs, but labor costs are up as well, as are the regulatory government friction costs. It takes longer to get zoning approval, whether you're in Europe or you're in North America. Everything just takes longer, and there's less finance available, and the finance that is available is at a higher cost. And so, in general, we understand replacement costs, meaning the cost to create and construct a new building, are up in some cases 25 to 40%, really since pre-pandemic. And rents have grown, but they really haven't kept pace. And so what that means is that developers are not able to generate an adequate return on their investment, given where rents are relative to how far replacement costs have gone up. That serves two purposes. One, that's a governor on how much new construction we're likely to see until rents grow higher. And that's the second point. There's a real support for further rent growth because rents are going to need to go higher to justify new construction, and there will be demand for new construction. We are seeing firming in certain segments. And so this is why it's so important to just boil down real estate fundamentals to the fundamentals of demand and supply and what that means for landlord pricing power. Again, we invest in the operators of properties. And so when you have demand exceeding supply as it is right now, landlords have pricing power. They're able to drive rents at or above the rate of inflation. You see real rent growth. And what's so important about that is when you turn to the next slide, you'll see what our expectations are for global REITs. We expect going forward the earnings profile for these companies to continue to accelerate. They bottomed a couple of years ago in 2024, and we expect earnings growth to be in the trend towards the upper half of a mid-single digit earnings growth. So it's going to be a steady income grower. The capital structures for these companies are in great shape, so there's going to be less leakage to finance costs. There'll be some, but there'll be less leakage than there has been historically. We expect the operating earnings to grow and the dividends to follow. So we're really quite constructive on the earnings outlook for the sector as a result.
Yeah, thanks, Rob. I must say those bar charts look like a bit of a roller coaster going to the COVID years and the unwind there that we saw. But just on those numbers, looking at that 6.3 and 6.9%, I mean, what are you factoring into those expectations? Is it a combination of the demand-supply dynamics that you spoke about? Is it the potential interest rate environment? Is it something a little bit different?
Yeah, so it's really driven by operating earnings. We expect landlords to have just to see improving fundamentals. So we expect occupancies to continue to trend a bit higher, and for rents to trend higher. So when you start to see revenue growth like that internally, provided that there's going to be discipline on the expense side, and certainly the companies are focused on that, then we're going to see NOI growth, net operating income growth. That's going to be the primary driver. But frankly, there's going to be additional growth coming from any external investment that they're able to do on a spread basis. So whether they're recycling assets through sales, whether they're doing net new investments, that'll augment the growth going forward.
Yeah, thanks, Rob. Well, let's shoot across to the other side of the world. Your next example here is out of Japan, and I think that chart in the bottom right there really does showcase that inverse relationship between rental growth and the vacancy rates.
Yeah, that's a great point. So, I wanted to talk to you about a real exciting company in the portfolios, Sumitomo Realty and Development. It's about a 45 billion, nearly 50 billion US dollar asset base, focused almost entirely on central Tokyo. About 80% of the portfolio is office, and the balance is residential, primarily condo developers. They've been at this for a very long time. Japan is enjoying a renaissance in terms of growth. It's enjoying growth that we really haven't seen in over a generation. The central 5 wards, which is really the central part of Tokyo, is firming considerably. There has been construction, and it actually has been well leased. And that's because with economic growth, you're seeing tenant demand growth. And so we are now at a point where demand growth, tenant demand, leasing activity is steady and growing, and there is not enough supply. As a result, vacancy rates are tipped below 2.5%, and rent growth has started to accelerate. We understand that in the last quarter, rent growth was over 5% in the central 5 wards, which is a very, very strong number for the Tokyo office market. We really haven't seen that, again, as I said, in over a generation. This is a stock that continues to trade at a discount to its net asset value, the underlying asset value of the assets. It's not a very lofty price to earnings multiple, and we expect the dividends to grow double digits over the next 3 years. So it's an important part of the portfolio. In the most recent quarter, it was up over 20%. And it's really because it's well positioned in a market that's quickly turning to a landlord's market where they can drive rents above the rate of inflation.
Thanks, Rob. You wouldn't have heard, but in a couple of the previous sessions, we spoke about the phenomenon of aging populations in the likes of Japan and China. And you are a man after my heart because you brought this back to North America and what's happening in the US. So maybe you can paint a picture for us on what that means for the market there.
So we're very constructive on seniors housing. And the way that we have exposure to that in the portfolio is through Welltower, which is about $130 billion market cap. It's the largest exposure in the company. Ventas, which is slightly smaller, but also significant senior housing owner-operator. And then Chartwell, which is a smaller company based in Canada. We're constructive on seniors housing because we think the demand-supply setup is going to lead to many years, 3, 4, 5+ years of strong internal growth. That's because the demographics really are going to drive demand here. We're now at the point where the baby boomers, those born from 1946 onward, are turning 80. And really, it's when you turn 80 is when you start to see populations move into purpose-built retirement senior housing properties. And so we expect demand, and you can see the chart on the left here in blue, the CAGR, the compound annual growth for people turning 80 up till 2024 averaged about 1.4% over the past 25 years. Actually, sorry, 15 years. And then prospectively, we think over the next 15 years, that's going to more than triple to over 5%. So we see a real pickup in demand. And at the same time, there is an adequate supply. And that's shown in the chart on the green where construction starts are down significantly. And that's because there's higher replacement costs. Rents are growing, but they're not at a point that justify new construction, and finance is still quite limited. And so we're now in a situation where we expect demand to accelerate, supply to continue to decelerate, which is just remarkable. And as a result, landlords have pricing power where they're going to be able to achieve a comfortable increase in rents above the rate of inflation, but not so much that they're gouging everyone's parents and grandparents. So we expect to see high teens internal growth coming out of seniors housing for the next, call it 3 to 4 years. And that's going to be an important driver for earnings growth for these companies. That's why we're so constructive on the outlook for seniors housing.
And I see the next slide here is the self-storage was quite a large contributor to performance. You have borrowed from Charles Dickens there, A Tale of Two Continents, and the book opens up with the lines, it was the best of times, it was the worst of times. And that seems to hold true across the different regions you're looking to discuss here.
We are overweight self-storage as a sector globally, predicated on the overweight exposure in the UK, Europe, and Australia, and on a strong underweight in the US. The chart on the top right here, I think, is really illustrative of the different dynamics that you can see across the different markets. What this shows is the self-storage square foot per capita in each market. In the US, it's over 9 square feet of self-storage per person, whereas in Australia, it's just over 2%. In the UK and in Europe, it's under 1 square feet per capita. We are underweight the US, which is the largest exposure to self-storage in the benchmark. We're underweight the US because it's oversupplied and underdemanded. And as a result, landlords do not have pricing power. And we are seeing rents fall 40% when tenants move out and new tenants move in the US. So we are not constructive on the outlook for self-storage in the US at this point in time. That said, it's a very different dynamic when you go to other countries. In the UK, there's a shortage of self-storage relative to other markets. And in the UK, we have exposure to Big Yellow Group, which we'll talk about in a minute, Safe Store, and also Pan-Europe, there's a company called Shurgard. We think that there is going to be increasing uses of self-storage over time and opportunities for landlords to grow their portfolios accretively. And then in Australia, we have exposure to a company called National Storage, which faces a similar dynamic. It has a little more supply, but not so much that they don't have pricing power. And the National Storage is also subject to a bid above net asset value, which we'd like to see a higher bid, and we've mentioned that to the company as well. So in the UK, our largest exposure in storage is to a company called Big Yellow. We think Big Yellow is a gem of a company. It owns 111 assets across the UK with 70% of the NOI coming from London and the Southeast, which we think is the highest household income area of the UK with significant constraints to supply. And as a result, we think that this is a company that has the opportunity to continue to grow its occupancy and its rents and drive earnings for the next several years.
You know, some of the main themes that you've highlighted in your outlook, and I don't know if there's anything you want to draw in terms of conclusions from this slide that we can take home with us.
Well, there's 2 things I want to talk about. It's just the operating outlook and then the return profile. We continue to believe that provided demand is stable and growing, which we believe is likely in more markets and sectors than not, that we are faced with a very friendly competitive supply environment where because replacement costs have gone up, there is less development going on that presents competitive threats to existing standing operating assets. As a result, we see that occupancies are continuing to trend higher, and landlords will have pricing power and able to drive rents at or above the rate of inflation. You see real income growth. The sector has weathered a couple of headwinds. Tariffs certainly were an incredible uncertainty and remain uncertain, but we feel like tenants are beginning to expand again, and they've figured out how to manage through this period of uncertainty. Real estate historically has employed a lot of leverage. We find that REITs capital structures today are as strong, if not stronger, than they've been at almost any time in their history. As a result, the balance sheets for these companies are lightly levered and provide the operators with tremendous flexibility on what they could invest in going forward. Additionally, additional investment will augment the internal growth profile of these companies. The companies aren't all trading at premiums, to say the least. There is value out there. We will see M&A. We're seeing some of it as we speak. As I mentioned, National Storage, one of the holdings in the portfolio, is subject to a bid. We are aware of others out in the market as well, and so we expect to see M&A as a possibility, and that just further underscores value in the portfolio. Now, I just wanted to remind everybody about the importance of the dividend. As the earnings continue to grow in the portfolio, we expect dividends to grow as well. They'll either keep pace with the earnings growth or slightly trail it. If they trail it, that means that there's going to be more retained earnings for the companies to reinvest. But over time, historically, dividends have represented nearly 2/3 of the total returns for global REITs. We expect that to continue going forward. So we think that there's good visibility on dividends for these companies, and that's an important part of the overall return for global real estate today. Thank you. Nice to speak with you. Have a great day. Thank you. Bye-bye.